Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Okay, so let's just dive right in. We're looking at Sleep Number Corporation, where the financial metrics and the market technicals are painting one of the most compelling and, frankly, highly binary situations in the public markets today.
Absolutely. And the price action just yesterday confirms it. It was, up 7%, down 4%, all on massive volume. It's trading like something is about to break.
Exactly. I mean, here we have a $1.4 billion annual revenue business, a major national brand, and it's trading with a market cap that's bouncing between, $170 and $200 million. That valuation implies a certainty of failure, a near guarantee of restructuring. But when you actually dig in, the source material just screams dislocation. It's all driven by technical factors. So the central question for us, I think, is this. Does the structural technical pressure from a massive short position combined with a new aligned leadership outweigh the absolutely crushing debt load and the tight covenant deadlines?
Right. And that's where we split.
It is. I'm arguing that this extreme short position creates an asymmetric upside opportunity. The market is just fundamentally over-discounting the intrinsic value of this business.
And I see it from the complete opposite side. That short interest isn't a market error. It's a rational, deep conviction bet. It's the market telling us this is a binary wager on an impending restructuring because of insurmountable debt. The technicals are just noise distracting from the fundamental financial signal. The valuation is low because the equity is, it's essentially worthless if the current debt architecture stays in place.
All right, well, my position really rests on the sheer absurdity of that valuation when you compare it to the operational metrics and the tinderbox the shorts have created. We're talking about a company that has proprietary technology, patented smart beds, a huge installed base generating valuable sleep data, a real technological moat, and yet it trades at roughly 0.14 times trailing revenue. It's being valued like a microcap with no viable product. And crucially, the operational reality of the business is so much stronger than the headline suggests. We have to look at the gross margin. Sleep Number maintains gross margins near 60%. That is an absolute fortress number. I mean, look at its peers. Tempur Sealy is typically in the 40 to 45% range. Purple is often struggling below 40. A 60% margin means every dollar of stabilized revenue drops enormous cash flow potential once the fixed cost base is properly managed. That gives them tremendous operating leverage. And what's more, the people in charge are aligned with the equity holders. The activist, Stadium Capital, owned 11.7%. They forced the board changes. The new CEO, Linda Finley, has recently bought, 104,000 shares for around $750,000. When management and activists are putting that kind of serious money on the line, real skin in the game, it just directly contradicts the bare thesis of guaranteed insolvency. You combine that with the mathematical tightness of a 35% short interest against a shrinking flow of under 15 million shares, and you have a coiled spring. It's just waiting for a single spark of positive news to force a massive short covering panic.
I'm sorry, but I just don't buy that the gross margin is the true measure of value here. High gross margins are a wonderful starting point, but they're completely irrelevant if the fixed costs from that 100% direct-to-consumer store model eat up all the operating profit and more. The valuation is rational, precisely because the $580 million plus debt load consumes the entire enterprise value.
Okay.
Let's just translate the financials into a simple cash flow reality. For fiscal year 2025, the company guided for adjusted EBITDA of only about $70 million. Now let's look at the interest line. Because of the punitive lending rates they agreed to in the 12th Amendment, their interest rate is pushing 8.5% to 9%. That means the annual interest expense alone is approximately $50 million.
Right.
So if you factor in necessary maintenance capex, the money just to keep the stores and tech running, which is maybe 25 to 30 million, you see the problem immediately. Even before paying down a single penny of principal, this company is structurally negative on free cash flow. Management's own projections confirmed a negative FCF of around $50 million for the full year 2025.
This means they are purely living on the credit card, dependent entirely on drawing down their reduced $465 million revolving credit facility. The short sellers are correctly betting that the tightening debt covenants, not some ephemeral short squeeze, will force the hand of the creditors. If that covenant is breached and they file Chapter 11, the equity holders are wiped out, period, regardless of what that smart bed data moat might be worth in theory.
That's a very compelling articulation of the get problem, I'll grant you that. But let me challenge the assumption that the problem is unfixable. And that brings us right to the credibility of the turnaround plan under CEO Finley. You correctly identify the high fixed costs, but her appointment, driven by the activist, is specifically aimed at tackling this operating leverage risk head-on. She has pledged $130 million in annualized operating expense reductions. That is a truly gargantuan number relative to their EBITDA base. This is the mechanism designed to push EBITDA from that $70 million to a target of, say, $100 to $120 million.
I appreciate the focus on her history, but execution means nothing if the economic environment is a headwind. Let's question the reliability of those $130 million in cuts. Are these structural cuts, like closing underperforming stores, which is hard to do quickly, or is it just deferred marketing spend and delayed CapEx? Because if consumer demand keeps on its current trajectory and revenue drops another 10%, say from $1.4 billion to $1.25 billion, the decline in gross profit will largely negate that promised reduction. The high fixed costs remain the anchor. If revenue slips, EBITDA stays stuck around $70 million, the FCF burn continues, and they get closer to maxing out that revolver. How reliable are these cuts really?
That's an excellent distinction, but her history suggests she's capable of both structural and temporary cuts. She is, rightly, being called a wartime CEO. She has a track record of stabilizing distressed operations, most notably engineering the sale of Blue Apron in 2023. Her strategy shift, which was pretty clear at CES 2026, isn't just about swinging the axe. It's about strategic repositioning towards simplification and potentially lower entry price points. The whole point of the $130 million cut is to lower the break-even point fast enough to weather exactly that 10% revenue drop you mentioned. If they can get to even $100 million in adjusted EBITDA, they secure FCF positivity. That provides the buffer to service the debt. It's a strategic shift that acknowledges they need to broaden their market, which gives those high gross margins a chance to finally generate real profit.
But repositioning takes time, and time is the one thing the credit agreement explicitly restricts. While the 12th Amendment did extend the ultimate debt maturity out to December 2027, which I know you see as breathing room, that room is contingent on them meeting immediate, strict financial hurdles that act as a technical ticking clock. I want to pivot to the structural risk of the net leverage ratio covenant step down. For anyone listening who doesn't live in the distressed debt world, the net leverage ratio is simply total debt divided by EBITDA. It's the metric lenders use to gauge risk.
And how tight is that clock right now? I acknowledge the covenants are strict, but how critical is this step down?
It's the ultimate tripwire. The covenant steps down from 5.25 times in the third quarter of 2025 all the way down to 4.50 times by the first quarter of 2026. Hitting that 4.5x target requires a sustained and immediate increase in EBITDA from the $70 million guidance or a major debt paydown which they can't afford. Failure to hit that ratio triggers a technical default, and at that point, the 2027 maturity date becomes utterly irrelevant because the lenders can accelerate the debt immediately. On top of that, the cost of the debt is punitive. It's termed so far plus 4%. When lenders impose rates like that, they're signaling they view this as incredibly risky. It's basically a margin call on the entire business.
That analysis of the leverage ratio is undeniable. It's the most critical non-technical threat. But the tightness of that situation is precisely what brings us back to the market dislocation and the short squeeze potential. The debt thesis assumes insolvency is a guaranteed outcome. Yet the technical setup suggests a massive market failure if the operational turnaround takes hold, even just marginally. Let me just reiterate the imbalance. 35.15% of the float is shorted. We estimate the true effective float, the shares actually available to trade, is less than 15 million. That creates a phenomenal structural imbalance. If Stadium Capital just decides to buy another 2 or 3 million shares, the tradable supply effectively vanishes.
I see why you'd think the shorts have pressed their bet too far, but I'd question the behavior of the sophisticated money driving this. this isn't just a retail phenomenon. The execution data suggests that something like 42% of the short volume is executed off-exchange, mostly in dark pools.
Okay, just for clarity for our audience, can you quickly explain what that means in practice?
Sure. Dark pools are private off-exchange trading venues. When institutional shorts execute that much volume there, it indicates meticulous risk management. They are explicitly trying to avoid putting public downward pressure on the price and, crucially, avoiding triggering the very volatility and retail frenzy that would cause the squeeze you're anticipating. They understand the liquidity dynamics. They're hiding their selling pressure.
That's an interesting point, though I would frame it differently. While they're managing their entry, they still eventually have to cover. You can't just manufacture liquidity if the music stops. It finally announces a strong Q4, showing they hit the savings target and FCF is nearing positive, retail volume will spike. How do these large institutions, who are short 8 days of volume, actually cover without causing a parabolic spike? They can't exit without buying.
They're betting on the long-term resolution, not the short-term volatility. The shorts are making a very calculated wager that the liquidity constraints and that tightening net leverage ratio covenant, that 4.50x tripwire, will force the creditors to restructure the debt before any operational turnaround can trigger a systemic short covering panic. So think of it this way. The smart money is betting the equity becomes a zero before they're forced to cover. If the company enters Chapter 11, the common equity is typically wiped out. The short profit is realized, and covering is done as essentially zero. The technical setup, as dramatic as it is merely a reflection of the fundamental debt risk.
But that requires immaculate timing from the bears. If they are even slightly early and the turnaround stabilizes FCF, the forced buying will be absolutely intense because the entire thesis of the short side is invalidated. You can't ignore the fundamental value that a 60% gross margin implies once the fixed costs are controlled. We've seen this pattern before, where highly indebted companies navigate the covenant walls, and the rally is exponential because the short base acts as guaranteed future demand.
I acknowledge the potential for a rally if they survive, but the margin for error is razor thin. They have to hit the covenant target while simultaneously executing $130 million in cuts without damaging revenue in a weak consumer environment. That's not just a high hurdle, it's an operational miracle. I believe the low valuation is warranted because the equity is a lottery ticket. It's either a 5x return or it's a zero. And the probability of zero is extremely elevated by the debt structure.
So ultimately, we're looking at two powerful conflicting signals. My summary remains that the extreme pessimism priced into Sleep Number at a sub-$200 million market cap is just excessive, especially given the brand's 60% gross margin and the unified front of activist and insider ownership. The risk-reward strongly favors the bull case, predicated on Findley's ability to execute that cost-cut program. If she succeeds, the technical structure of the short position all but guarantees a substantial aggressive recovery.
And my summary is that the market is accurately pricing the debt risk, focusing on the financial architecture over theoretical value. Solvency depends entirely on achieving aggressive, sustained EBITDA growth in a profoundly challenging consumer environment, just to satisfy those unforgiving and compressed net leverage covenants. The very real potential for a debt restructuring to wipe out common shareholders means the low valuation is entirely warranted. The spectacular short interest is just a rational bet that the debt wall will hit before the operational runway can ever be utilized.
It really is a fascinating convergence of deep value principles intersecting with the high-risk dynamics of distressed debt. The listener is left to weigh whether the structural, technical pressure from the shorts or the stringent demands of the financial metrics provide the truer signal for Sleep Number's immediate future.
A complex investment profile indeed, and there's far more to explore in the material about how these two forces, the technical and the fundamental, are going to battle for control in such a time-constrained environment.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.